The night silver collapsed wasn't just another blip on a chart. It was a moment that sent shockwaves through the entire financial world. Picture this. It's just after midnight in New York, and the markets are supposed to be quiet. Most traders are asleep, the news cycle is slow, and the world is distracted. But in the shadows, something is brewing. Suddenly, in the space of just a few minutes, the price of silver plunges hard. Screens flash red, stop losses trigger, margin calls start rolling in. In chat rooms and on social media, panic spreads like wildfire. Some are glued to their screens, watching their positions evaporate in real time. Others wake up to devastation, their portfolios gutted before they even had a chance to react. If you missed this, you missed history in the making. This wasn't just a dip, it was a full-blown flash crash, the kind of event that only comes around once in a generation. For those who were there, it felt like the rules of the game had changed overnight. For those who weren't, the aftermath was a wake-up call. In today's markets, fortunes can be made or lost in seconds. But what really happened that night? Was it a coordinated attack? A cascade of algorithmic trades, or something even deeper? The mainstream media rushed to offer simple explanations, but the real story is far more complex and far more important for anyone who cares about their financial future. Before we reveal the truth behind the silver fever crash, hit subscribe and comment, Silver Strong, if you want to stay ahead of the herd. This is the analysis the mainstream won't touch. Don't risk being left in the dark when the next shock hits. Stay informed. Stay empowered. This video is intended for educational and informational purposes only. The content presented is based on research and general knowledge and should not be considered professional advice. To understand the chaos of the silver fever flash crash, we need to rewind and look at the wild ride silver has taken in recent years. Silver has always been a metal with a split personality. On one hand, it's the classic safe haven, the asset your grandparents might have tucked away for a rainy day, a hedge against inflation, a store of value when the world seems uncertain. On the other hand, silver is a battleground, a playground for speculators, hedge funds, and retail traders alike. And in the months leading up to the crash, that battleground was more volatile than ever. Let's set the stage. Over the past year, silver's price chart looked less like a steady climb and more like a roller coaster. There were sudden surges, fueled by headlines about inflation, supply chain disruptions, and whispers of a new commodities supercycle. Each spike brought a fresh wave of excitement. Social media buzzed with talk of silver squeezes, and online communities rallied around the idea that silver was the next big thing. For a moment, it seemed like everyone wanted a piece of the action. But beneath the surface, the story was more complicated. While mainstream financial news outlets continued to tout silver as a reliable safe haven, the reality was that the market had become a high-stakes casino. Leverage was everywhere. Retail traders, emboldened by easy access to margin and inspired by viral stories of overnight riches, piled in. At the same time, institutional players, armed with sophisticated algorithms and deep pockets, were making moves of their own, often in the opposite direction. This wasn't the silver market of old. The lines between physical and paper silver blurred as ETFs and futures contracts became the weapons of choice. The volume of paper silver traded on exchanges dwarfed the actual physical supply, creating a disconnect that few outside the industry truly understood. The result? A market that could swing wildly on the smallest catalyst, where a single large order or a sudden shift in sentiment could trigger a cascade of buying or selling. And all of this was happening against a backdrop of global uncertainty. Central banks were printing money at unprecedented rates. Inflation fears were mounting. Geopolitical tensions simmered. In this environment, silver became a lightning rod for both hope and fear, a symbol of financial independence for some, and a speculative gamble for others. But here's the truth the mainstream rarely admits. While the headlines focused on silver's role as a safe haven, the real action was happening in the shadows. It was a game of insiders versus outsiders, institutions versus individuals, paper versus physical. The stakes were high and the rules were changing fast. As we peel back the layers of this story, keep one thing in mind. In the world of silver, what you see on the surface is only half the story. The real drama is playing out behind the scenes, and if you're not paying attention, you could be left behind. So how did all these forces come together to set the stage for one of the most dramatic crashes in recent memory? The warning signs were there, but almost everyone missed them. Demand, but beneath the surface, a very different story was unfolding. And the weeks and months leading up to the silver fever flash crash, the warning signs were everywhere, if you knew where to look. But most people didn't. The mainstream media, always eager for a simple story, focused on silver's steady climb and the narrative of a safe haven asset in uncertain times. Headlines celebrated new highs and retail enthusiasm, painting a picture of a market driven by fundamentals and long-term. Let's start with the numbers. Open interest in silver futures was surging to levels not seen in years. For For those unfamiliar, open interest measures the total number of outstanding contracts in the futures market. When open interest rises rapidly, it's a sign that more and more players are entering the game, often with borrowed money using leverage to amplify their bets. In the weeks before the crash, open interest didn't just rise, it exploded. This wasn't just a few extra traders joining the party. It was a flood of new money, much of it from retail investors, emboldened by stories of quick riches and viral social media campaigns. At the same time, silver ETFs were seeing record inflows. These exchange-traded funds, which allow investors to buy exposure to silver without ever touching a physical bar or coin, became the vehicle of choice for a new generation of traders. Inflows hit all-time highs, with millions of ounces of silver being bought on paper in a matter of days. The media reported this as a sign of growing confidence in silver's future. But what they didn't mention was the growing disconnect between the paper market and the physical supply. The sheer volume of ETF inflows far outstripped the amount of silver actually available for delivery. This imbalance was a ticking time bomb, but few seemed to notice. Meanwhile, social media was ablaze with hype. Influencers and anonymous accounts on platforms like Reddit, Twitter, and YouTube were calling for a silver squeeze, urging followers to buy up physical silver and hold it tight. The idea was simple. If enough people bought physical silver, they could force a short squeeze in the paper market, driving prices to the moon and punishing the big banks and hedge funds. The movement gained traction, with hashtags trending and online communities swelling in size. For many, it felt like a revolution, a chance for the little guy to strike back against Wall Street. But while retail traders were rallying online, institutional players were making moves of their own, moves that went largely unnoticed by the public. In the shadows, hedge funds and proprietary trading desks were quietly adjusting their positions. Some were building massive short bets, betting that the silver rally was overextended and due for a correction. Others were using complex options, strategies to hedge their exposure or profit from volatility. These were not the kind of trades that made headlines, but they were significant. The smart money was preparing for something big, even as the crowd cheered for ever higher prices. There were other signs too. Volatility in the options market spiked, with premiums on out-of-the-money puts and calls reaching extreme levels. This was a clear signal that traders were bracing for a major move, up or down. Liquidity in the futures market began to thin, making it easier for large orders to move the price dramatically. And behind closed doors, whispers circulated about margin requirements being quietly raised by some brokers, a move that often precedes sharp market corrections. Yet through it all, the mainstream narrative remained unchanged. Silver was a safe haven, a hedge against inflation, a smart play in uncertain times. Few questioned the sustainability of the rally, or the risks lurking beneath the surface. The focus was on the headlines, not the data, on the excitement, not the danger. This is the nature of financial markets. The most important signals are often the ones that go unnoticed, drowned out by noise and hype. The build-up to the silver fever crash was a perfect storm of retail enthusiasm, institutional maneuvering, and structural imbalances. The signs were there for anyone willing to look past the headlines. But as history has shown time and again, most people only see the danger when it's too late. So what happened when all these forces collided? In a matter of minutes, the market would be turned upside down, and the true nature of modern finance would be laid bare for all to see. It began with a flicker, barely a blip on the radar for most, but for those watching closely, it was the first tremor before the earthquake. The clock had just ticked past midnight in New York. In the dim glow of trading screens around the world, silver's price hovered near recent highs, buoyed by weeks of relentless optimism. But beneath that calm surface, the market was a powder keg, primed for ignition. The first spark came in the form of a large, unexpected sell order. It wasn't a gradual unwinding or a cautious step back. It was a sudden, forceful move. Tens of millions of dollars worth of silver contracts dumped onto the market in seconds. The order sliced through the thin overnight liquidity like a hot knife through butter. Prices dropped instantly, falling by nearly $1 in the blink of an eye. For a brief moment, there was confusion. Was this a fat finger error? A rogue trader? Or something more calculated? But before anyone could answer, the algorithms kicked in. In today's markets, human reaction time is no match for the speed of machines. High-frequency trading bots, programmed to sniff out momentum and exploit volatility, detected the sudden drop and sprang into action. Sell signals flashed across their networks, and within milliseconds, a wave of automated selling cascaded through the order books. The effect was like a dam breaking. Each new sell order pushed prices lower, triggering more algorithms to join the stampede. The market, already thin and vulnerable in the overnight hours, became a battleground of machines, each one racing to get out before the next. In less than a minute, silver had lost another $2. For traders watching live, it was surreal. Prices that had taken weeks to climb were erased in seconds. But the real chaos was just beginning. As the price plunged, margin calls started to hit. For those unfamiliar, margin is borrowed money. leverage that amplifies both gains and losses. When prices move against you, brokers demand more collateral to cover potential losses. If you can't pay up instantly, your positions are liquidated, sold off at whatever price the market will bear. In a flash crash, this process becomes a vicious cycle. Falling prices trigger margin calls, which force more selling, which drives prices even lower, triggering more margin calls in a relentless feedback loop. Retail traders, many of whom had piled in with borrowed money, were caught completely off guard. Some watched in horror as their accounts were wiped out in real time. Others, asleep or away from their screens, woke up to find their positions liquidated at the worst possible prices. Social media lit up with stories of devastation, screenshots of accounts reduced to zero, angry posts about brokers and manipulation, and desperate questions about what had just happened. But it wasn't just the little guys who got hurt. Institutional players, too, were caught in the crossfire. Some hedge funds, having bet heavily on continued gains, scrambled to unwind their positions. Others, who had been short, suddenly found themselves in the driver's seat, but even they had to navigate the chaos carefully. Liquidity had all but vanished. Bid-ask spreads widened dramatically, and even large players struggled to execute trades without moving the market further. Meanwhile, the options market was in turmoil. Traders who had bought out of the money puts, bets that silver would fall, saw their positions explode in value. But for every winner, there were dozens of losers. Those who had sold options, expecting calm, faced massive losses as volatility spiked and prices swung wildly. The premiums on options contracts soared, reflecting the sheer panic and uncertainty gripping the market. Amid the carnage, exchanges and brokers scrambled to keep up. Some platforms experienced outages or delays, unable to process the flood of orders. Others raised margin requirements on the fly, forcing even more liquidations. In chat rooms and trading forums, confusion reigned. Was this a coordinated attack, a glitch in the system, or simply the brutal logic of modern markets where speed and leverage can turn a small spark into a raging inferno? To put it in perspective, imagine a crowded theater where someone yells, "Fire." The first few people rush for the exits, but soon the entire crowd is stampeding, each person's panic fueling the next. In the world of high-speed finance, that stampede happens in milliseconds, and there's no time to think, only to react. By the time the dust began to settle, silver had lost nearly 15% of its value in less than an hour. Billions of dollars had changed hands. Fortunes were made and lost in the blink of an eye. For some, it was a life-changing windfall. For others, a devastating blow. The aftermath was a landscape of confusion, anger, and disbelief. But perhaps the most striking aspect of the flash crash was its speed. In the old days, market moves of this magnitude might have taken days or weeks to play out. Now, thanks to leverage, algorithms, and 24/7 global trading, it all happened in minutes. The rules of the game had changed, and those who weren't prepared paid the price. This is how fast fortunes can change in today's markets. One moment, you're riding high, convinced that the trend is your friend. The next, you're staring at a screen, watching your hard-earned gains evaporate before your eyes. The Silver Fever flash crash was a stark reminder that in the world of modern finance, risk is always lurking just beneath the surface. But the story doesn't end with the crash itself. In the hours and days that followed, the true winners and losers began to emerge. Some managed to escape with their profits intact, while others were left picking up the pieces. The aftermath would reveal not just the financial toll, but the deeper lessons about how markets really work and who they really serve. So who came out on top and who was left behind? The answers might surprise you. In the wake of the Silver Fever flash crash, the market was left in a state of stunned silence. The dust had barely settled, but the consequences were already rippling through trading desks, brokerage accounts, and online communities around the world. The chaos of the night before had redrawn the lines between winners and losers, exposing the brutal realities of modern finance and leaving everyone asking the same question: who came out on top and who was left behind? For many retail traders, the aftermath was nothing short of devastating. In the days leading up to the crash, optimism had been sky high. Social media was filled with stories of everyday people betting big on silver, convinced that a new era of wealth was just around the corner. Some had leveraged their positions, borrowing against their accounts to maximize their gains. Others had poured their savings into silver ETFs or futures, swept up in the excitement of the silver squeeze movement. But when the crash hit, that optimism turned to panic. Margin calls wiped out accounts in seconds. Stop-loss orders, meant to protect against losses, were triggered en masse, often at prices far below what traders had expected. For many, there was no time to react, no chance to salvage their positions. The market had moved too fast, and the losses were immediate and severe. The emotional toll was palpable. Online forums and chat rooms became support groups for the shell-shocked. Stories poured in. A father who lost his child's college fund, a retiree whose nest egg was decimated, A young trader who watched months of gains vanish in a single night. There was anger at brokers, at manipulators, and at the system itself. There was confusion as people tried to make sense of what had happened. And there was regret as the reality set in that the warning signs had been there all along, but had gone unheeded. But not everyone lost. In fact, for a select group of traders and institutions, the flash crash was an opportunity, a chance to profit from the panic. Some hedge funds, having anticipated the overextension in the market, had built short positions in the days before the crash. When prices plunged, they covered their shorts at a massive profit. Others, armed with sophisticated algorithms, were able to react in real time, buying at the bottom and selling into the rebound. These players weren't relying on hope or hype. They were reading the data, watching the signals, and acting with ruthless efficiency. Then there were the physical silver holders, the so-called stackers. For them, the crash was a different kind of test. Unlike paper traders, stackers weren't watching their positions get liquidated in real time. Their silver was in their hands, in vaults, or tucked away in safe deposit boxes. The price on the screen was just a number, not a trigger for forced selling. In the days after the crash, many stackers doubled down on their conviction. They saw the volatility as proof of the instability of the paper market, a reminder of why they held physical metal in the first place. Some even took advantage of the lower prices to add to their stacks, confident that the long-term fundamentals remained intact. The contrast between paper and physical holders couldn't have been starker. Paper traders were at the mercy of algorithms, margin requirements, and the whims of the market. Physical holders, by contrast, had a sense of control, however illusory, that came from owning something tangible. In the aftermath, this divide became a rallying cry in the community. If you don't hold it, you don't own it, became a mantra, repeated in forums and videos as a warning to those who had been burned by the crash. Institutional players, for their part, emerged from the chaos with a mix of wins and losses. Some had been caught off guard, their models unable to predict the speed and severity of the crash. Others, however, had positioned themselves perfectly, using their resources and experience to navigate the turmoil. For these players, the flash crash was just another day at the office, a reminder of the risks and rewards that come with playing at the highest levels of finance. But perhaps the most important lesson from the aftermath was not about who won or lost, but about who was prepared. Those who saw the signs, the surging open interest, the record ETF inflows, the growing disconnect between paper and physical markets, were able to act before it was too late. They reduced their leverage, tightened their risk controls, or simply stepped aside and waited for the dust to settle. For them, the crash was a validation of their discipline and foresight. For everyone else, the flash crash was a wake-up call. It exposed the vulnerabilities of a market driven by leverage, speed, and speculation. It revealed the dangers of following the crowd, of ignoring the warning signs in favor of hype and hope. And it underscored the importance of independent thinking, of doing your own research, and of being ready for the unexpected. Those who saw the signs were ready. Were you? In the world of silver, as in all markets, fortune favors the prepared. The aftermath of the crash was a harsh lesson, but for those willing to learn, it was also an opportunity, a chance to rethink, regroup, and come back stronger. And as the world tried to make sense of what had just happened, the ripple effects of the silver fever crash were only beginning to be felt on a global scale. As the sun rose over Asia, the aftershocks of the silver fever flash crash were already rippling across the globe. What began as a sudden, violent move in the New York futures market quickly became a worldwide event, with each region responding in its own way, some with panic, others with calculated intervention, and all with a sense of unease that something fundamental had shifted. In Tokyo and Shanghai, traders woke to chaos. Asian markets, often the first to react to overnight moves in the West, saw silver prices gap down at the open. Retail investors in Japan, many of whom had joined the silver rush through popular trading apps, found themselves staring at losses they hadn't anticipated. In China, where silver has long been both an industrial metal and a speculative favorite, the crash triggered a wave of selling in related stocks and ETFs. The Shanghai Gold Exchange, which also trades silver, saw volumes spike as traders scrambled to adjust their positions. For many, the crash was a stark reminder of the risks that come with following global trends without understanding the underlying volatility. Europe's response was more measured, but no less significant. In London, the world's largest physical silver market, dealers reported a sudden surge in inquiries from both institutional and private clients. Some were looking to buy the dip, convinced that the crash was a temporary aberration. Others were desperate to sell, fearing further declines. The London Bullion Market Association issued statements reassuring clients about market stability, but behind the scenes, liquidity was tight, and premiums on physical silver began to rise. In Germany and Switzerland, where precious metals are seen as a bulwark against financial instability, demand for physical coins and bars spiked. Dealers reported shortages and delivery delays as investors rushed to secure tangible assets in the face of paper market turmoil. Governments and regulators, too, were forced to respond. In India, where silver is a key component of both industry and tradition, authorities moved quickly to calm the market. The Securities and Exchange Board of India issued temporary restrictions on leveraged silver trading, hoping to prevent a similar cascade of margin calls. In the United States, the Commodity Futures Trading Commission launched an inquiry into the causes of the flash crash, promising to investigate any signs of manipulation or market abuse. Across the globe, central banks and financial authorities monitored the situation closely, wary of contagion spreading to other markets. The shockwaves didn't stop with silver. Other commodities felt the tremors as well. Gold, often seen as silver's more stable cousin, experienced a brief spike in volatility as traders rushed to rebalance their portfolios. Industrial metals like copper and platinum saw increased selling pressure as investors moved to raise cash and reduce risk. Even oil and agricultural commodities were not immune, with some funds forced to liquidate positions across the board to meet margin calls triggered by the silver crash. Yet, the global reaction also revealed unique vulnerabilities in different regions. In Asia, the rapid adoption of mobile trading platforms meant that retail investors were more exposed to sudden market moves, often without the risk controls or experience to weather the storm. In Europe, the reliance on physical bullion created bottlenecks and supply shortages, highlighting the fragility of just-in-time delivery systems. In North America, the sheer scale of leveraged trading amplified the speed and severity of the crash, raising questions about the resilience of the financial system itself. Through it all, one thing became clear. The silver fever flash crash was not just a local event, but a global phenomenon. It exposed the interconnectedness of modern markets, the speed at which panic can spread, and the challenges faced by investors and regulators alike. As the world took stock of the damage, the question on everyone's mind was the same. Could it happen again? And if so, who would be ready? The answer would depend on how the lessons of this crash were understood and applied, not just in one country, but across the entire financial landscape. The silver fever flash crash wasn't just another wild swing in a notoriously volatile market. It was a seismic event, a moment when the old rules were shattered and the true nature of silver was exposed for all to see. In the hours and days that followed, as the world tried to make sense of what had happened, it became clear this was the turning point. Silver would never be the same. For decades, silver had occupied a unique place in the financial world. It was the people's metal, accessible to ordinary investors, cherished by stackers and respected as a hedge against inflation and uncertainty. It was a symbol of independence, a tangible asset in a world increasingly dominated by digital abstractions. But the flash crash revealed a new reality, one where silver was no longer just a safe haven, but a battleground, shaped by leverage, speed, and the relentless logic of algorithms. The crash exposed the fragility of the market structure. The sheer volume of paper silver, futures, ETFs, and derivatives had grown to dwarf the physical supply. In theory, these instruments were supposed to make silver more accessible and liquid. In practice, they created a market where prices could be whipsawed by forces far removed from the underlying metal. A single large order, a shift in sentiment, or a cascade of margin calls could send prices spiraling in either direction, with little connection to real-world supply and demand. This disconnect was a wake-up call for investors everywhere. The old belief that silver's price was anchored by its physical scarcity was shattered. Instead, the market was revealed as a high-stakes game, where speed and information mattered more than fundamentals. For many, this realization was deeply unsettling. The sense of security that came from holding silver, whether in a vault or on a screen, was replaced by a new awareness of risk, complexity, and unpredictability. But the impact went deeper than just market mechanics. The flash crash changed the psychology of silver investors. For some, it was a moment of disillusionment, a realization that the market could be manipulated, that the little guy was always at a disadvantage, and that the dream of a silver squeeze was just that, a dream. For others, it was a call to arms. The crash became proof that the system was rigged, that only those who truly understood the game could survive. Online communities rallied around new mantras. If you don't hold it, you don't own it. Trust no one but yourself. The divide between paper and physical holders grew wider, and the sense of us versus them intensified. Institutions, too, took notice. The flash crash forced a reckoning among hedge funds, banks, and regulators. Risk models were recalibrated, margin requirements were reviewed. The possibility of similar events in other markets was suddenly very real. The crash became a case study in the dangers of leverage, the speed of modern trading, and the limits of market oversight. And yet, amid the chaos, a new kind of opportunity emerged. For those willing to adapt, the new silver market offered both risk and reward. The volatility that had destroyed some accounts created windfalls for others. The lessons learned in the crash about risk management, independent thinking, and the importance of preparation became the foundation for a new generation of investors. The message was clear. The old playbook no longer applied. To thrive in this new world, you had to be faster, smarter, and more resilient than ever before. This is the turning point. Silver will never be the same. The flash crash was more than a market event. It was a transformation. It forced everyone, retail traders, stackers, institutions, and regulators, to confront the realities of a market that moves at the speed of light, where fortunes can be made or lost in seconds, and where the only constant is change. If you're watching this now, you're witnessing history. The story of silver has entered a new chapter, one defined by uncertainty, innovation, and the relentless pursuit of truth. The question is no longer whether silver is a safe haven, but whether you're ready for the world that comes next. Because in the aftermath of the crash, one thing is certain: the future belongs to those who can see the signs, adapt to the new reality, and act before the rest of the world catches on. So, where does silver go from here? After a flash crash of this magnitude, the future is anything but certain. But one thing is clear: the landscape has changed, and those who adapt will be the ones who thrive. Let's look at the possible scenarios, the new dynamics shaping the market, and the strategies you can use to stay ahead of the next shock. First, expect regulatory scrutiny to intensify. The speed and severity of the crash have already caught the attention of global regulators. In the coming months, we could see new rules aimed at curbing excessive leverage, increasing transparency in derivatives trading, and tightening oversight of high-frequency trading algorithms. Exchanges may raise margin requirements or introduce circuit breakers to slow down extreme moves. While these changes might make the market safer on paper, they could also reduce liquidity and create new risks, especially for retail traders who rely on flexibility and access. Second, the structure of the silver market itself is likely to evolve. The divide between paper and physical silver has never been more apparent. We may see a renewed push for physical delivery, with more investors demanding allocated storage and direct ownership of metal. Premiums on physical silver could remain elevated, especially if supply chain disruptions persist, or if trust in paper instruments continues to erode. At the same time, new financial products, like blockchain-based silver tokens or decentralized trading platforms, could emerge, offering alternative ways to gain exposure while sidestepping some of the pitfalls of traditional markets. Third, investor psychology has shifted. The crash has left a mark on everyone who experienced it, and that memory will shape behavior for years to come. Expect more caution, more skepticism, and a greater emphasis on risk management. The days of blind optimism and YOLO trades may be over, at least for now. Instead, the winners will be those who do their homework, question the narrative, and prepare for volatility rather than fear it. So, what can you do to protect yourself and position for the future? Here are a few actionable insights. Not advice, but principles that have stood the test of time. First, respect leverage. The flash crash was a brutal reminder of how quickly leveraged positions can unravel. If you use margin, know your limits, and have a plan for when things go wrong. Don't let a single trade wipe out years of hard work. Second, diversify your approach. Don't put all your eggs in one basket, whether that's paper silver, physical metal, or any other asset. Consider a mix of holdings and think about how each piece fits into your overall strategy. Remember, the goal isn't just to chase returns, but to survive and thrive through all market conditions. Third, stay informed and question everything. The warning signs before the crash were there for those willing to look. Monitor open interest, ETF flows, and changes in market structure. Pay attention to regulatory developments and shifts in global sentiment. Don't rely solely on mainstream headlines or social media hype. Dig deeper, seek out independent analysis, and connect with communities that value truth over noise. Fourth, build your own network. The silver community is full of experienced stackers, analysts, and independent thinkers. Join forums, follow credible voices, and share your own insights. In times of crisis, information and support from a trusted network can make all the difference. Finally, embrace uncertainty. Volatility isn't going away. It's part of the new normal. Instead of fearing the next shock, prepare for it. Set clear goals, define your risk tolerance, and be ready to act when opportunity knocks. The future will reward those who are adaptable, disciplined, and willing to learn from the past. As we look ahead, remember, the next big move in silver could come when you least expect it. The market is evolving, the rules are changing, and the only constant is uncertainty. But with the right mindset, the right tools, and the right community, you can turn that uncertainty into opportunity. Stay vigilant, stay curious, and never stop learning. The story of silver is far from over, and the next chapter is yours to write. The Silver Fever flash crash was more than just a market event. It was a wake-up call for anyone who cares about financial independence, truth, and resilience. We've seen how quickly fortunes can change, how the old narratives can crumble, and how the real story often unfolds far from the headlines. The crash exposed the vulnerabilities of a market built on leverage and speed, but it also revealed the strength of those who are prepared, informed, and connected. If there's one lesson to take away, it's this. In today's world, you can't afford to be passive. The difference between winners and losers isn't luck. It's preparation, vigilance, and the willingness to question what you're told. The mainstream will always offer easy answers, But the real insights come from digging deeper, thinking independently, and learning from the community around you. This is where the us versus them dynamic truly matters. It's not just about retail versus institutions or paper versus physical. It's about a mindset, a commitment to seeking the truth, sharing knowledge, and supporting each other through the ups and downs. When you join this community, you're not just a spectator. You're part of a movement that values transparency, empowerment, and action. So, if you found value in this deep dive, don't keep it to yourself. Subscribe to the channel, hit the notification bell, and drop a comment below with your thoughts or your own story from the crash. Share this video with friends and fellow stackers who need to hear the real story. Every voice matters, and together, we can build a network that's stronger than any market storm. Remember, the next chapter in Silver's story is being written right now, and you have a role to play. Stay informed, stay connected, and never stop questioning. The Silver Revolution isn't just about metal, it's about mindset, community, and the courage to stand apart from the crowd. Join us, and let's shape the future of silver together.